Listen, guys, this market doomer stuff out there really makes me mad because actually the real estate market and the impending crash doesn't matter if you're doing things right. Who it matters to are the people that are out there speculating. So, what I'm going to show you in this video is why it doesn't matter, why most people are out there speculating, and they are the ones that are going to get screwed if the market crashes. And three, I'm going to show you how you do things to make sure that if that does happen, you're in a fine position. So let's start with looking at some of the past crashes. All right, so apparently there was a post-pandemic crash in around 2022. That was the biggest period of wealth building in my whole entire career. In fact, if I didn't look it up online, I wouldn't even realize that a crash ever happened. And then if you rewind a little bit further to like 2007, 2008, that's the crash that everybody's talking about. And it was really bad. But if you look at the numbers, it was bad to the tune of about 30%. Okay, that matters a lot for speculators. And here's the thing. There are two types of appreciation. There's market appreciation and there's forced appreciation. And what a lot of investors out there do, who aren't really investors, they're speculators, is they buy properties and they hope that the market wins. The market appreciation brings the value of their property up. So when they go to sell it or refinance it for a rental, it is now at the value that they need it to be in a good position. So let's talk about market appreciation a little bit. If I buy a house today for $300,000, the average appreciation over the past 30 years, according to the numbers that I found online, is around 4.7%. That's pretty high, but let's just say that you bought a house that was worth $300,000 today. In 30 years, at 4.7% appreciation, that house would be worth around $900,000. Now, that is the beauty of real estate, that the market always appreciates over time. That's why real estate is the single greatest investment, because it has been winning for thousands of years. There's no reason to believe that it's not going to win in the long term for you as well. But in the short term, it could have some bad days, like in 2008 when the market crashed by around 30%. That means that the house that you thought was worth $300,000 is now worth around $210,000. That's a 30% dip of the price. That's a bad situation to be in. But there's another type of appreciation, which if you follow the solo house flipper methodology, that's exactly how we buy, is by using forced appreciation. And what that means is that I'm not buying a $300,000 house today for $300,000. I'm going to buy a house that needs some work first. I'm going to buy that $300,000 house for maybe $150,000 because it needs a lot of work. Okay, so I'm going to have to put around $50,000 of a rehab into it. And then I'm probably going to have around $10,000 of other costs. Let's think insurance, utilities, closing costs, other things that I haven't said here, but that's not what this video is about. So I'm going to be all in for around $210,000. You get the point here? I'm all in for $210,000 on that house that I thought was worth $300,000. Then the market crashes by 30%. Now it's worth $210,000. That sucks for sure. I didn't make any money off of it. But that's not the kind of lose your ass stuff that everybody's talking about, how all your savings forever are going to be wiped away, that you're going to lose your personal house and so on and so forth. No, you're just going to break even, or maybe most likely lose a little bit of money on that deal. But is that the end of the world? And here is the other thing, that you don't lose money until you sell. It's all on a piece of paper until you go and sell the property. So here's what happens if the market does take a turn for the worse. You take that same house that you bought for $150,000, put a $50,000 rehab into, and you go to a bank. Well, first, you would put a tenant in the place. You would rent it out to somebody because you have a house that's now renovated. You can put a tenant in it. It's livable. They start paying you rent. You go to the bank and you say, hey, bank, I would like to refinance this house. You go to a bank or a DSCR lender. These are people who will give you, this is important, a fixed rate long-term mortgage. So most of the mortgages we get from DSCR lenders are 30-year fixed terms. That means that's 7% interest, but it's a fixed term. There's no balloons on it. It's not going to, in 5 years, I have to pay it off, or in a couple years, the interest rate changes. No, it's a fixed rate for 30 years. I pay the mortgage every month with the money that I get from the tenant. And over time, that mortgage goes down to zero. Okay, so let's go back to over the long term, real estate always increases through market appreciation. So you understand forced appreciation now. Now let's go back to market appreciation. Market takes a dip. Now the house is worth $210,000. Now I have a tenant in it who's paying me rent that I'm using to pay the mortgage. So it's not money out of my pocket. When people start talking about cash flow, that's what they mean. I have even or positive cash flow because the tenant pays me, let's say $2,000 a month. My mortgage is, let's say, $1,500 a month. Now I'm in positive cash flow. Just a side note, that situation is unlikely on a house where you'd have $500 of cash flow, because if you are getting $2,000 from the tenant and you have a $1,500 mortgage, that's your principal, your interest, your taxes and insurance. You still have to figure in things like maintenance, capital expenditures, vacancy. Not what this video is about. So that's not $500 a month you're putting in your pocket. On a single family home, you're going to be lucky to get to just positive cash flow. But you're not in negative cash flow. You're covering your mortgage. You're paying down the mortgage every month. Still with me? Okay. So now I have this tenant in here, and now I just wait 5 years. Property's worth $210,000 in 5 years at the 4.7% interest. That's going to be around like $265,000, $270,000. It's now back up. Remember, I only have $210,000 in the deal. Now it's worth $270,000. Boom. Now I have equity again because I just waited. Because once again, I don't lose until I sell the property. I was able to hold on to it. That's the beauty of real estate, that once it is in a livable condition, it can be monetized either by selling or renting it out. So we rented it out. We had to wait a little bit. We didn't get to grow our business to infinity. We had to wait. We had to be patient, but that's okay. Patience always wins. Okay. Now, this is the bedrock of the solo house flipper methodology. By the way, we have a free school community, not going to be free forever. It's free right now. Link in the description. Check it out. You can ask me any question. I answer it every day, every question, every day with stuff like this. This is usually the type of video that you would get in response to a question that you might ask. Okay, so here are the bedrock rules that we follow. You always get a great deal on the front end. You never overbuy. You never get antsy, especially in a time like this, because it is true. The market is a little bit shifty right now. It's a little bit unknown what's going to happen. It's clear that it's not raising, inflating like it has been for the last 10 years or so. It's really at a standstill. We don't know which way it's going to go. Is it going to go up? Is it going to go down? I don't know, and I don't care. I would love for it to go up, but I don't know that's going to happen. So I need to make sure that today I have created an equity gap. So I need to get a great deal on the front end. The $150,000 for a house that's worth $300,000, that's not an unlikely situation if you know how to hunt for deals, because this house needs work, okay? And you get paid for being an investor who's going to do the things that other people wouldn't do. You get paid for taking houses that are less than livable and using your skills, your knowledge of the market, and putting forth risk to renovate that house and bring it to a livable condition. And you get paid because other people aren't going to do that. The government's not going to do that. The person who owns the house isn't going to go do that because it's a headache, but it's the headache that you chose in becoming a real estate operator or real estate investor. And that's what you get paid for. And that's why every property you buy, you're going to instantly have an equity gap in. So let's just say that the market did stay even on this example that we were talking about. You're all in for $210. It's worth $300,000. Obviously, if you go to sell that house, it's not going to be $300,000 in your pocket because you're going to pay real estate fees and closing fees on the back end. Let's just say, for rough figuring, that's like 10%. So of the $300,000 value, the sales price, you're probably going to pocket 270. You had 210 in the deal. You've had a $60,000 equity gap. Great, right? And if the market crashes, it closes, but you don't lose your butt. You just break even, or maybe have to put a little bit of money into it. So you always get a great deal on the front end. You always write a stellar scope of work on the front end. Sorry, ripping here. Yeah. You always write a stellar scope of work that you don't change throughout the project. And this is a really important thing. We talk a lot on this channel and in the school community about writing smart scopes of work that you don't get coaxed into changing during the project, because that is the thing that happens to a lot of people, is the whole to give a mouse a cookie phenomena, where you see one thing and you feel like you got to do it, and once you do that thing, it makes another thing look crappy, and then you have to do that. You got to set a scope of work at the beginning, and then you stick to it throughout the whole project, and you stick through it through great execution of your project management. And those are really the three big pieces there. Great deals, great scopes of work, stellar project management. And then one other thing is just financial management of yourself. So the thing is that if we have this $50,000 renovation, we're not going to hope that the $50,000 is made during the project. We're going to make sure that we put that money aside, putting it in escrow during the project. So if you buy that house, the market crashes while you own that house, well, you already have that $50,000 set aside for the renovation. You have nothing to worry about. All you got to worry about is your exit strategy. Are you going to refinance it, or are you going to sell it and take your little lump at the end? And that's why, guys, yes, I know that there's a lot of talk out there about the market crashing and all the market doomers out there. But the reality is, people talk about that stuff because you click on that stuff to watch it, that they know it's going to get views, and views builds their business. Is there some fear out there? Absolutely. But guys, there's always that fear out there. And, the whole time I've been investing in real estate, over 15 years now, people have always been talking about the market crash. Rich Dad, Poor Dad guy, Robert Kiyosaki, the dude has been talking about the greatest market crash to come since whatever for the whole time I've been in real estate, and it still hasn't come. There's the little blip in 2022 that I didn't even know happened. And so let's just think, if 5 years ago or 10 years ago I said, well, you know what? Market might crash. You're right. And so I guess I should hold out and wait so I can get some great deals. I would have missed out on the biggest wealth producing portion of my career. And you don't want to do that. And so you got to get in the game, but you got to be smart. And that applies whether it's right now when things are a little bit questionable, and it applies when things are great. And in fact, when things are great, it's even more important, because that is what happens. The good times turn smart real estate investors into speculators. And speculators are people who don't think about the forced appreciation. They're thinking about the market appreciation. If I buy this house today for $300,000, by the time I get done renovating it, the market will have appreciated by $50,000. And so it'll be a great deal. No, that's stupid. Okay, that's getting too far out over your skis. When you get too far out over your skis, you buy a bunch of properties like that, and then all of a sudden the market dips by 10, 20, 30%, you're in a really bad position. So be smart now when things are questionable, but focus harder on being smart when things are great. But I promise you, real estate always works. Been working for thousands of years. It's going to work for you. You just got to make sure that you stay patient and get great deals and manage effectively.